Section 1. The year everything changed, 2024, and the return of financial fear. The year began with a sense of optimism. Investors were hopeful, and the general sentiment was that the worst was behind us. The stock market was on an upward trajectory, and there was a palpable sense of relief in the air. The COVID-19 pandemic was fading into memory. Economies were reopening, and businesses were starting to thrive again. People were returning to their normal lives, and there was a collective sigh of relief as the world seemed to be healing. Markets, buoyed by loose monetary policy and government stimulus, seemed to defy gravity. The influx of capital and the support from governments around the world created an environment where growth seemed inevitable. Stocks were reaching new highs, and the future looked bright. But beneath the surface, a storm was brewing. Despite the outward appearance of stability, there were underlying issues that were beginning to surface. The signs were subtle at first, but they were there for those who were paying attention. By spring, cracks began to appear in the financial system. Indicators of financial instability started to emerge, and the initial optimism began to wane. Analysts and experts started to voice their concerns, but their warnings were largely ignored. A series of high-profile bank failures sent shockwaves through global markets. These failures were not isolated incidents but were indicative of deeper systemic issues. The ripple effects were felt across the world, and the initial shock turned into widespread panic. Fear and uncertainty gripped investors and policymakers alike. Meetings were held behind closed doors, and emergency measures were discussed. The sense of unease was palpable, and the confidence that had characterized the beginning of the year was quickly eroding. The year 2024, once a beacon of hope, became synonymous with the return of financial crisis. Headlines were dominated by news of the market crash, and the optimism that had defined the start of the year was replaced by a sense of dread. The crisis of 2024 served as a stark reminder of the fragility of the global financial system. It highlighted the vulnerabilities that still existed and the need for vigilance and reform. The lessons of the past seemed to have been forgotten, and the consequences were severe. It exposed the vulnerabilities of interconnected markets and the ever-present potential for panic to overwhelm reason. The interconnectedness of the global economy meant that no country was immune, and the crisis spread rapidly, affecting markets and economies worldwide. Most importantly, it underscored the enduring relevance of history in understanding the complex dynamics of boom and bust. Financial experts drew comparisons to previous market crashes, analyzing the patterns and cycles that seemed to repeat themselves. The crisis of 2024 was a harsh reminder that history often repeats itself, and the lessons of the past must be heeded to avoid future calamities. In the aftermath, policymakers and financial experts began to discuss the need for future reforms. The crisis had exposed significant weaknesses in the financial system, and there was a consensus that changes were necessary to prevent a similar situation from occurring again. The discussions were intense, and the stakes were high. As the dust began to settle, investors cautiously returned to the market. The road to recovery was long and fraught with challenges, but there was a sense of determination to rebuild and learn from the mistakes of the past. The events of 2024 would not be forgotten, and they would shape the future of the financial world for years to come. Section 2. Echoes of the Past. A History of Boom and Bust. The story of financial markets is one of cycles where periods of exuberant growth are often followed by sharp contractions. This cyclical nature has been observed for centuries, and understanding it is crucial to navigating the complexities of modern economies. Financial crises are not new. They have been a part of human history for as long as markets have existed. Each crisis, while unique in its specifics, shares common patterns and lessons that can be learned. They are a recurring feature of modern economic history. These crises often follow a predictable pattern, starting with a period of rapid economic growth and rising asset prices, followed by a sudden and often catastrophic collapse. From the tulip mania of the 17th century to the Asian financial crisis of the 90s, history is replete with examples of speculative bubbles, financial panics, and economic downturns. The tulip mania, for instance, saw the price of tulip bulbs skyrocket to extraordinary levels before crashing down, leaving many in financial ruin. Similarly, the Asian financial crisis was marked by the rapid devaluation of currencies and a severe economic downturn in several Asian countries. These crises, while often triggered by specific events, share common underlying causes. Understanding these causes can help in predicting and potentially mitigating future crises. Excessive leverage or borrowing to invest is a common thread running through these crises. When investors take on too much debt, they become vulnerable to market fluctuations. A small decline in asset prices can lead to a cascade of selling, as investors are forced to liquidate their holdings to meet margin calls. When asset prices rise rapidly, fueled by easy credit and speculative fervor, investors are tempted to take on more debt to amplify their returns. This behavior is often encouraged by a period of low interest rates and a general sense of optimism about the future. This creates a dangerous feedback loop, where rising prices beget more borrowing, which further inflates prices. As more and more investors pile into the market, the bubble grows larger and more fragile. Eventually, the bubble bursts, leaving investors with unsustainable debt burdens and triggering a wave of defaults and financial contagion. The aftermath of a financial crisis can be severe, leading to widespread economic hardship, loss of jobs, and a prolonged period of economic stagnation. Governments and central banks often step in to stabilize the situation, but recovery can take years, if not decades. Section 3. The Ghost of 2008. Subprime mortgages and the specter of systemic risk. No recent crisis looms larger in the collective memory than the global financial crisis of 2008. Triggered by the collapse of the U.S. subprime mortgage market, the crisis exposed the interconnectedness of the global financial system and the dangers of systemic risk. The rapid proliferation of complex financial instruments, such as mortgage-backed securities and credit default swaps, had obscured the true risks embedded in the system. When the U.S. housing bubble burst, the losses on these opaque securities rippled through the financial system, bringing down major banks and financial institutions. The crisis highlighted the importance of understanding and managing systemic risk. The risk that the failure of one institution can trigger a cascade of failures throughout the system. Section 4. A new crisis for a new age. Distinctive features of the 2024 debacle. While the 2024 crisis shared some similarities with past crises, such as the 2008 financial meltdown and the dot-com bubble of the early 2000s, it also exhibited distinctive features that reflected the evolving nature of the global economy. The world had changed significantly in the years leading up to 2024, with new economic players and technological advancements reshaping the landscape. One key difference was the role of technology. Unlike previous crises, where technology played a supporting role, in 2024, it was at the forefront. The rise of fintech, or financial technology, had revolutionized the way financial transactions were conducted. From mobile banking apps to blockchain technology, fintech had become an integral part of the financial ecosystem. This technological revolution led to the emergence of new financial actors and markets. Traditional banks were no longer the only players. Online lenders, peer-to-peer lending platforms, and cryptocurrency exchanges had become significant forces in the financial world. These new players, such as online lenders and cryptocurrency exchanges, operated in a space that was often less regulated than traditional financial institutions. This lack of regulation created both opportunities and risks. Often operating outside the traditional regulatory framework, these new entities introduced new sources of risk and complexity to the financial system. Regulators struggled to keep up with the rapid pace of innovation, leading to gaps in oversight. This added complexity made the financial system more vulnerable to shocks. The interconnectedness of these new markets with traditional financial systems meant that a problem in one area could quickly spread to others. Another distinguishing feature of the 2024 crisis was the speed and ferocity with which it unfolded. Unlike previous crises that developed over months or even years, the 2024 debacle erupted almost overnight. The interconnectedness of global markets played a significant role in this rapid escalation. Financial markets around the world were more interlinked than ever before, meaning that a crisis in one region could quickly affect others. Amplified by high-frequency trading algorithms and social media sentiment, the crisis spread with unprecedented speed. High-frequency trading, which involves the rapid buying and selling of securities, exacerbated market volatility. Social media also played a crucial role. Platforms like Twitter and Facebook allowed news and panic to spread at lightning speed. Rumors and misinformation could go viral within minutes, adding to the chaos. This rapid transmission of fear and uncertainty made it more difficult for policymakers to contain the crisis and restore confidence. Traditional methods of crisis management were often too slow to be effective. Policymakers faced unprecedented challenges in responding to the crisis. The speed at which events unfolded left little time for deliberation. Immediate action was required, but the complexity of the situation made it difficult to devise effective solutions. Efforts to restore confidence were hampered by the sheer scale of the crisis and the speed at which it spread. Traditional tools, such as interest rate cuts and liquidity injections, had limited impact in the face of such rapid developments. The 2024 debacle highlighted the need for new approaches to crisis management, ones that could keep pace with the fast-moving financial landscape.